Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is assessing whether or not the slowdown is transitory or maybe more than that. All right, we often refer to 2008 as the Great Recession, or sometimes it's called GFR, right? The Great Financial Recession. But the numbers that we've seen in this past week make 2008 look mild, right? We are seeing numbers that are far, far in excess of anything that we witnessed during the depths of 2008. That's quite a statement, right? We had retail sales numbers, right? The 1 month change in retail sales numbers was four times larger. In fact, it was over 4 times larger than any decline we even experienced in 2008. The great one, right? And Chairman Powell this week also noted that the economy still continues to face unprecedented risk. His term. So, what we thought was a 1 or 2 month slowdown and things might get back to normal. I've been telling you all along, I never believed that to be the case. Just the magnitude of this headshot is so massive. There's just no way that we're going to bounce back. There's just no way, no chance for a V-shaped recovery. It cannot be transitive at all. At the very least, the slowdown is going to linger through the remainder of the year. And again, as the Federal Reserve Chairman cautioned, we probably are looking 1 to 2 years out. We're not looking months. We're probably looking 1 to 2 months out, 1 to 2 years out before things return. So if we've got consumption numbers that are horrific. Now, one thing I want to point out, remember, within those consumption numbers were online sales, right? We're all supposed to be at home, and you would have thought that the online sales would have been doing pretty well. But even the online sales weren't doing that great. Obviously, the department store sales and so forth were horrendous, right? 4 times worse than anything in 2008. Now, we're going to look at some of the manufacturing data today. And I mean, it's just eye-popping, the magnitude of these numbers. 2008 doesn't even compare. The Great Recession doesn't even compare. I'm sorry, not the Great Depression. Right? The only comparable we had before this past week was possibly 2008 or the 1929 Depression. We have blown all those out of the water. That's how intense the magnitude is. So if people aren't spending and we're not manufacturing anything, what do you think is going to happen to corporate earnings? Shit, we don't need to pass around the smelling salts to figure this out, people. Earnings are going to plummet massively. So this rebound that we've seen in equities is really makes me scratch my head. I just do not believe this. Let's take a look at some of these manufacturing numbers here. I'm going to start off here with capacity capacity utilization. All right. So capacity utilization first, before we discuss the chart, is a rate, right? It's the amount of the productive manufacturing capacity that we're using today, right, relative to the full output amount. All right. So how much could we be producing? Given the facilities in place today, right? That's going to be the denominator, right? Best case scenario. And then what are we getting in terms of output today? That's the numerator. All right, so let's take a look at this chart here. The most recent observation is down here with the dotted black line. All right, and it came in just shy of 65. Just shy of 65. Now this data series goes back to the mid-60s here. All right, and you can see where we were at in 2008. We are far below anything in 2008. In fact, we're far below anything over this entire time frame. The other thing I'd like to point out is we blame a lot on the coronavirus, and rightly so. But take a look at this. This slowdown here started in October or November. It started in late 2018. We started to slow, manufacturing started to slow a long time ago. Now the virus, of course, has accelerated the hell out of it. But we had started to slow a long time ago. And we are seeing numbers. Again, these are April numbers. You think May is going to look much different? Probably not. And we're seeing numbers here just like we've never witnessed before. All right, let's keep going. Cat Butte. Okay, here we have industrial production. Year-on-year change in U.S. industrial production. All right, this one doesn't look so bad. All right, we dropped 15%. That put us on par to the very depths of the 2008 recession, right? The very depths. Again, you can see where we were, and this slowdown has been in place for a while, and then where we're at as of the most recent reading here, April 30th. All right, on a year-on-year basis, not so bad. Well, I say not so bad. It's still the worst we've ever seen and comparable to the depths of 2008, but the chart isn't completely destroyed. This is the 1 month change, right? Here we're looking at year-over-year changes. So April of 2019 to April 20th. If we look on a monthly basis, just from March to April, you can see 11.25% fall. Right? And again, look for the dotted black line. And I use that dotted black line so I can compare the most recent reading to previous times in history. Here is a worst case during the 2008 slowdown. What was that, 4.5% or something? We're at 11.25%, right? Just the magnitude of these numbers. We knew the numbers were going to be soft. We knew the numbers were going to be soft. It's just the oh my gosh factor. They're so soft. Right? They are just blowing, just eye-popping. It's not just the U.S. either. Right? We got a GDP number out of the U.K. They had to go back 300 years to find anything close to the GDP number they got. Just most recently printed. We got German and Eurozone GDP numbers. Again, falling off a cliff. 2008 isn't a relevant comparison. The Great Depression isn't a relevant comparison anymore. This idea of immediate bounce back, it's just not going to happen. This was not a body blow. This is far more severe than that, based on the magnitude of these numbers. So, why am I highlighting all this? Well, one of the main risks we got going forward here is going to be bankruptcies, right? Credit downgrades and bankruptcies. Credit downgrades, I'm talking about corporations losing their investment grade status and falling in the junk category, right? That's going to be a huge event. It's coming. And you see, based on these numbers, you know it's coming, right? Earnings are going to fall off a cliff very quickly, and you're going to see the credit agencies react. So we have credit downgrades and bankruptcies, two big waves coming at us here, and so the aftermath of the coronavirus is not over, right? We've only experienced stage one so far, or you might say we've had two stages. So we had the healthcare crisis, which gave rise to the financial crisis, which gave rise to the oil crisis. Remember the negative $40 oil. All right. So you might say that we've had two stages so far, but we've got more to come at us here, folks. There is a time when you're investing, there's a time for offense and there's a time for defense. And I know this equity rally that we've witnessed is tempting, but you want to continue to play defense. You want to adjust your risk profile with wealth preservation in mind, right? We'll worry about building wealth later. Today, I strongly suggest you think about and focus on wealth preservation. Okay, so that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep. We'll talk again soon. Thank you.